The prevailing double-digit interest rate in Nigeria is killing investors, interest stifling businesses and the economy. Of course, they say that that's according to the Nigerian Senate.
Now, the rate set by the MPC is the rate at which the CBN lends money to commercial banks. After the upward review of that rate from 12 to 14%, commercial banks also increased their interest rate by between 27% and 29%, depending on the bank.
Now, while Nigeria's interest rate is 14%, those of other developing countries are not that high. For South Africa, it's 7%, Rwanda 6.3%, Botswana 5.5%, Cameroon 2.5%. Kenya is 10%, Bangladesh 6.8%, Brazil is 10.5%, just among others.
Now, some economists say that this is the major reason the Nigerian economy has not grown and gotten better over the years. All right, issues of interest rates is what we'll be talking about right now, and the Nigerian economy. We have an economist with us, Professor Kenife, joining us from our Abuja studio. Prof, good morning.
Hi, good morning. Thanks for inviting me.
Thank you very much. All right, now, Professor, make us understand, when we talk about interest rates, to make it very simple for the average businessman on the street or a startup or anybody working on the street to understand, how central are the issues of interest rates to a growing economy or any economic indices for that matter?
Interest rate is very, very central to business. Even families are affected by interest rates. All aspects of the economy are all affected in one way or the other by the prevailing interest rates in the economy, without a doubt. Families have to borrow money to even send their children to universities. Families have to borrow money to even feed the family where they are waiting for salaries to be paid, and they have to pay interest. So there's a lot that happens to the economy. Businesses can operate if they are having to contend with an extremely high interest rate regime. So the issue becomes, how do we get to the bottom of it, and what is the way out?
All right, so what are the key factors government should consider before setting interest rates at a particular percentage point for the sake of the economy?
First, let's come to terms with the drivers of high interest rates. One of them is the CBN sets the monetary policy rate, which has been at 14% for quite a while, between 12 and 14% over the last 2 years. Now, that is the baseline reference point. That's the point, the rate at which it lends to even the banks. Now, the second one is that there is a discrepancy between the demand and supply side of our forex. We rely monoculturally on oil for supply, but then foreign investments account for a stabilization factor. So you see the rates chasing foreign investment. But yeah, a lot of foreign investments are coming, so that can augment the resources available to the bank to provide for forex. Now, that is also possible because if you look at what happened in America, Federal Reserve Bank, that was undergoing a program of quantitative easing over the years since 2008, brought interest rates down to between 0.5 to 1 or 2. So money were flowing in here to earn higher interest. But now with the normalization of their monetary policy, some of these monies are having to flee. But the third one, of course, is government borrowing. Now, government borrowing has been quite substantial, and the government has to go to the market to borrow at a rate much higher than our base rates. So that's why you see yields on securities and government bonds are going up between 15 and 20%. Now, what it means is actually you have diversion of resources. You have the banks going in to buy the government treasury bills, take your money and go and buy the bills, and they cannot lend to you below those 20%. So that's why they have to lend to you at rates much higher than 20%, 20 to 30%, and then microfinance banks will do 30 to 40 or 50%. So, you know, we get to the root of this. This is why if you diversify the economy and provide more alternative revenue source, foreign forex revenue source to the government, it then encourages the banks to bring down the rates because there is a balance of foreign reserves and foreign resources available to them to pay for the import bill. Remember also, the high import bill is part of the challenge because that is what is piling the demand pressure on the forex. So you know, the government is caught in between. But of course, the person that is slaughtered by all this is the MSMEs. They can't borrow money to produce anything. In fact, the people that are borrowing money at those phenomenal rates are the traders that take the money for 3 months, 6 months, and then they buy cheap goods they import in from China or elsewhere, and then sell them at exorbitant price and make the money so they can afford to buy, rent, and take money at those rates. The manufacturers can't. They cannot. And this is the big challenge. So it affects growth. It affects the whole demand, supply in the economy. And domestic economy is suffering as a result of this.
Now, talking about the demand and supply on forex that you mentioned earlier on, now how more complicated it is for our economy where we have multiple exchange rates as far as forex is concerned?
I don't link those actually. I mean, there is a tenuous link, but it's not as material to the issue of interest rates because obviously the forex regime is influenced by interest rates, but it doesn't account for the gaps that you are pointing your hands to. I think what is very critical is how do we ensure that there's a diversity of revenue base to the CBN so that it can deal adequately with the demand placed on it by forex. And then also we have to act seriously on the demand side to make sure that what we are spending that money for is necessary and appropriate. And that's why diversification and import substitution strategies in a diversified economy are a very critical way going forward.
All right, CBN Governor Godwin Emefiele said that the bank cannot reduce the interest rate to avoid worsening inflationary pressures on the economy. Do you agree with him, or there is a way CBN could still reduce it and then make small businesses, MSMEs, get loans at cheaper rates?
If you look at the communique of the bank, even the last one, and they always argue those 2 points. They recognize that it is important to reduce these rates so that you can encourage growth in the economy, because when you have growth, you have more employment. But of course, they are also faced with the crisis of supply of forex resources, and then they're going to attract investment. Although there is some imbalance in the investment being attracted, to be honest, because there is more portfolio investment coming in, which, you know, is short-term debt flow. So they're in and they could be out. Even before you blink your eyes, they're out. But the main longer-term perspective that is brought by foreign direct investment is not as strong as we would want. And I know that part of the challenge is because they are watching market conditions. And market conditions are beginning to improve. As you saw that we just climbed out of recession, albeit very slowly. But if we do have more and more growth on the horizon, and then of course you see the inflation is also coming down very marginally. But if we have more steeper drop in inflation, there are market conditions that make the foreign direct investors want to engage and bring more money. And those more money would mean more forex resources.
All right.
So in that respect, it's difficult for the CBN to do more than what they're doing at the moment. And don't forget that there's pressure, massive pressure from government borrowing. Now, government borrowing is at a rate much higher than the CBN base rate. And then that also means that government is even going to have more problem with handling inflationary pressure. Look, for example, the proportion of money paid on debt servicing is gone high. Sure. It's over 40%. Now, that's the red line. And this is because the government revenue are dropping while the interest on borrowing is rising. So what they actually pay out as a proportion of what the total money that the government receives is high. So that also has ripple effect on the economy. They have less to spend. Government have less to spend to stimulate the economy, and then it goes round and round.
All right, the government, even the past administration, even up until now, we hear them talk about patronized or made in Nigeria goods, and so how is that? How can that help the interest rates if Nigerians buy into the made in Nigeria products?
Oh, without a doubt. You know what that means? Made in Nigerian products means we are patronizing our local resources, we're creating more employment on the ground, we are substituting the import that would have been eating up all our foreign exchange, we're reducing the pressure on foreign exchange, and you're empowering the people, you're building more jobs, you're building more businesses on the ground, and it's incredible. It's incredible we're going forward. So we need to not only substitute the import, but government patronage of made in Nigeria is critical because government is the biggest buyer, and it sends a strong message to the manufacturers: come in, I will patronize you, and that makes a huge difference.
All right, you said earlier that market conditions are improving, especially now that the country has exited a recession, that it will encourage foreign direct investments. But then it seems that what we've seen in the past months reveals that investors at the moment are more interested in investing in treasury bills, trading in treasury bills, than which is somehow harming FDIs and, of course, ultimately Nigerian economy.
Well, we may say so, but I hope that the diversification will be strong enough, the recovery and growth will be strong enough to give them the confidence. But when you have a fragile recovery, investors are still sitting on the fence as to whether to commit their resources to a long-term prospect. But when there is the recovery is strong. Okay, let me give you an example. The recovery was 0.55%. Now that is hardly enough to deal with two issues. One, the population growth rate is 2.45%. Then secondly, the urbanization rate is 4.85%. Now, the growth of food production, agriculture must outstrip that. It must be at 5% or more. And consequently, all the growth in the economy aggregated together must be over 5%. And that's why the government is targeting 7% by 2020. And that is the level where you can actually dent the figures. That is where people will see more confidence and more sustainability. So we are going there, we are getting there, but it's quite slow.
All right, from the standpoint where we are right now, Prof, do you see the likelihood that Nigeria can achieve the single-digit interest rates anytime in the near future?
It's possible, but it's just how long is it going to take? Because, first of all the factors playing on this would have to come to equilibrium. Not when you are getting $1.2, $1.3 billion revenue and you are having a request of $4.6 billion revenue. That gap is not enough for you to drop your guard, because you still have to look for other forex sources to be able to augment. And mind you, for example, if 32% of the forex requested is going to refined oil products being imported into the country, obviously by next year and the year after, if we move up to 60% self-sufficiency in imported fuel and all that, on fuel products, then that's fine. It means we are reducing the demand for forex. And there are many other things. Some of those 41 items that were banned, if we pick up on a substitution of those products, then of course we are reducing the... So you may move to a position where the demand on forex has actually reduced to about 3 billion or 2.5 billion. And then now you can see the bank likely to take more risks on lowering the base rates and the interest rates, following it down. Interest rate will normally follow the base rate anyway, although not on a one-on-one basis.
All right.
But it sends that message. But of course, if the government If the government reduces their borrowing, then that also gives less options to the banks in terms of where they dump their money. At the moment, they take your money and give it to buy the treasury bills, and they sit down and do nothing. And then the main people who need to be giving the money to produce in the economy and create jobs are just standing by and watching. So it's not the best situation, to be honest.
All right, so let's look at the monetary policy regime in the country. It seems that it's not really doing what is expected to do in rescuing Nigeria's economy. And of course, there is still the issue of fiscal policy. It seems the two are not on the same page.
No, I don't agree with you on that, because I believe that the bank has fought. You know, it was the last man standing over the last 2 years, fighting, and there was very little support from other policies, and that was about 2 years ago. You know, I'm talking about fiscal policy, you know, monetary, fiscal, industrial, trade, agri-investment policy. They were not there, you know, at that point to support it. So that, but now they're all on board. You know, you now have a different case altogether. You have an economic recovery and growth plan that is very robust. You have all the players locked into there. You have macroeconomic policy convergence. And then you've got the CBN fighting furiously since February, pumping money into the industrial base to ensure that they are recovering. The industry is recovering. The PMI is very positive consecutively for the last 5 months. So they haven't been, it's been you know, tough for the bank. And you see, you cannot expect monetary policy alone to deliver the economy. It's not possible. But within the confines and within the resources available to them, they are fighting. But they need help. And because the foreign investment is just one other way it could earn more forex, then they'd have to maintain a reasonably high interest rate to attract that constituency. And of course, that problem was compounded by government's hunger for borrowing, and government is borrowing, both domestically and of course foreign. But the foreign is a different ball game. We need more foreign borrowing because it carries a restriction that is going to go to capital expenditure, and then the interest rate is lower, and you know, there is a balance there.
All right, Prof. We read out earlier in our statistics several African countries who maintain or who have a single-digit interest rate: Kenya, South Africa, Ghana, and so many others, Rwanda, and so many others. Now, these countries, most of them have almost the same social challenges Nigeria has, almost the same kind of or similar economic challenges, similar political challenges. But what are they doing that they have been able to sustain and maintain a single-digit interest rate that Nigeria can't?
Well, the thing is that Nigeria is not alone, to be honest. We are in the first quartile of the highest interest rates, without a doubt. And you've mentioned some of those that are on the second and third quartile. Now, Nigerian economy is different. And in fact, every economy is different. If you look at West African countries, Nigeria accounts for 80% of manufactured goods in Africa. The manufacturing capacity in West Africa is Nigeria. And that's why we're having issues with signing the EPA agreement. So, but there are some economies that don't have much manufacturing capacity, and then they depend on low cost imported goods, so they want low tariffs, and then all of that stuff. So the economies are different. Our economy is totally based on, is monocultural. That's okay. If you look at Ivory Coast, for example, Cote d'Ivoire, why is our diversification index is 1 because it's monocultural or a petroleum? Their own is about 7. They have 7 independent resources that are earning them foreign exchange. So if 1 or 2 crash, they're still there. We're earning money. And Ghana also has more, you know. So the thing is that we need to, South Africa, of course, is very well diversified economy, very industrial. So we need to get to that point. We have the resources to get there. We have one of the ways to actually do this is to command a very low interest rate for agriculture. If agriculture takes 5% maximum, you know what it will do? It will generate a lot more jobs for people, because 70% of employment is in agriculture. It will provide a lot of raw materials for the industrial value chains to kick in, and it will push up. So when you are now talking about sustainable export of agro-based resources, then you have it. But not when you have people taking things, they run to Igbo market, collect something and run to London to sell it, and then they go to Wuse market. That is not it. You know, we've got to get down to the price, because at the moment, all those 70% jobs that are in the economy that are dependent on agriculture, they cannot borrow money to produce. Subsistence farmers cannot borrow your money at the rate at which you're offering them to produce.
Professor Ken Ife, you're an economist, and thank you for your analysis on the current interest rates in Nigeria. Thank you for coming on the show.
My pleasure. Thank you.